All right, how's it going, friends and family? So it seems like you guys really liked the United Healthcare stock analysis deep dive video that I just uploaded. Well, today we're going to be talking about a company that I have bought and sold multiple times in the past decade. And by the way, I'm still overcoming jet lag, but I'm feeling a lot better. I woke up today at like 2 a.m. in the morning, but it is what it is. The company is TARJ, aka Target Corporation. And there's a lot about this company that sticks out to me. Their dividend yield right now is just shy of 5%, and they've been growing their dividend payout for the past 55 years. They have a polarizing opinion from investors and consumers alike. You either love Target or you hate them. There's not many people out here that are neutral towards Target. And the craziest factor surrounding Target is that they're going on a very brutal sell-off. They were $260 a share back in 2021. So what the heck is going on? Is this a good investment? That's what I'm trying to figure out if I want to buy into Target or not. And as you can see on your screen right now, according to this stock chart, their total return in the stock market just on share price appreciation alone, not taking into account the dividends, is 3,200%, which if you zoom out 40, 50 years, that's not that impressive to say the least. But without further ado, let's go ahead and talk about Target's business overview, how they make money, and what's their biggest growth driver going forward. Oh, and by the way, this is the table of contents, how the video is going to flow. And in the pinned comment and in the video description, I'll leave you guys timestamps for the ones with ADD or ADHD. So let's talk about their business overview. Target is the 7th biggest big box retailer in the US, and they operate exclusively in urban cities and metropolitan suburbs. And I believe about 75% of the American population live within 10 miles of a Target. And unlike Walmart, Target likes to be located next to populations with bigger wallets. So even though you might see Walmart and Target as apples to apples, dude, you're so wrong, because they're not really going after the same demographic and customer. And according to global data, the average household income of Target's shopper, the average shopper, is roughly $79,000. On the other hand, the average Walmart consumer, well, their salary is $62,000. And another differentiating point is that Target's marketing strategy is to be the trendy place to shop. And their whole personality is that they're not a Walmart, whether that's a good or a bad thing. And in a Target store, you'll find everything ranging from vacuums to laundry, detergent, and even grocery items. In total, as a company, they have 15 different retail categories that they are tracking, mostly in the discretionary spending aisle. The big three include beauty and household essentials, clothing, and home decoration, with groceries just outside of the top three. Target even used to have their own pharmacy. However, they sold that operation to CVS, and now CVS pays Target rent money to do business inside of a Target. And 15 years ago, up until recently, I used to exclusively buy my clothes from Target because I love that they don't plaster a logo all over the chest for their store brand. And I'll stand on this tiny hill, and you might disagree, and I'm going to say this. Their Goodfellow store brand is some of the highest value clothing available for men. I'm telling you. So if you're a man in the US, listen up, which statistically 99% of the viewers of this channel are. If you want good quality clothing at bargain prices that fit really well, dude, go to Target. Their jeans, chino pants, khaki pants, basic tees, really good stuff. And as a guy that really likes board games, Target usually has exclusive offerings on the latest and the best board games. And I think this is room for opportunity, because imagine if Target were to carve out a chunk of their store space to be like a Barnes & Noble, a bookstore with a cafe. I know that's just me talking out of my butt, but I feel like Target could become that third place that people hang out and buy stuff at. Like, instead of staying at home and scrolling on TikTok, imagine if the catchphrase is, hey, let's just go to Target and hang out, right? I could really see that happening if they were to implement my stupid idea. But anyways, Target is slowly transitioning from using human capital in the stores, and now they utilize so much self-checkout and the Dollar General strategy, which if you don't know, it's to understaff the stores in order to maximize your margins. Because if you're paying for employees and staff that are not optimized for their output, then you're kind of losing money. And that's why Dollar General does that. They perpetually understaff their stores, and it's really frustrating to shop there. And it's sad to see that Target is copying that. For the customer, this is going to lead to a frustrating situation because you might need something that's locked away on the shelves, and then having to find someone and then flag them down to help you out could be like a game of Where is Waldo, right? Or hide and seek. And the reason why I say this is sad is because for the longest time, the shopping experience was the economic mode and the differentiator. But now I just feel like that's out the window. So to sum it up, how do they make money? Target makes money from people buying stuff on the shelves or ordering from Target.com. And what is their biggest growth driver going forward? Well, based on my research, I think it's their supply chain network, revolving around their stores rather than distribution centers like Amazon. About 95% of their sales are fulfilled by store associates, including online orders. I think that's pretty smart. So the store as hub omni-channel strategy is pretty witty because it saves on overhead costs associated with warehouses and factories, and then those trucks having to drive 150 or 500 miles to deliver to the next distribution hub. They don't have to deal with that. The stores are that. Now, don't get me wrong, Target does absolutely have fulfillment centers and warehouses, but they maximize and utilize their stores rather than just relying on those warehouses, if that makes sense. So with Target, you can do a drive up, order pickup, or even same day delivery, which is a convenience that customers love, and I think that's their growth driver. I know it's a weak one, but it's just what I think. Now let's talk about the arguments against Target. So number one is tough competition. Walmart and Costco are stealing loyal Target customers because of their recent political statements and political actions that they have made. And we're going to talk more about this in the earnings report when we go over that. But if you're not up to date, a few years ago, Target went all out on inclusive messaging and branding. This made the conservative shoppers really angry. And I remember it was all over Instagram, on YouTube, and on TikTok that they wanted to boycott Target. And I think they did. Then, this past year, dude, this is going to sound crazy, but it happened, okay? Target decided to go anti-woke, and they reversed course on their DEI measures. Now, this made the left angry and boycott Target. So in a span of 3 years, Target alienated and polarized both sides of the spectrum and pissed off their loyal shoppers. So stupid. And number two is their consumer discretionary focus, which means when times are tough, Target is one of those places people will reduce spending money at. Think of it as buying things that aren't necessary to sustain life, buying random crap as a luxury. And number three is what the heck is their unique factor? Because when I think about it, I don't think they have a clear value proposition. They don't have the lowest prices. They don't have the highest quality products. They don't have the best selection, diverse offerings, and their e-commerce platform, dude, it absolutely sucks in comparison to Walmart and Amazon. So I just feel like their brand needs a rehaul and they need a new identity. And did you know in 2015, Target quit its expansion into Canada? They were doing it for 2 years, and they closed all 133 stores. Dude, I learned about this in a Harvard Business Review article, and this is just really sad. They had supply chain inventory issues, and the prices in their Target stores in Canada were a lot higher than the competition, which means they didn't do their research, and their procurement team sucks. And as a result, the Canadian customers were just not shopping at a Target. So if you think international expansion is the lifeline that Target needs, then think again. They already tried it and failed miserably. Enough with the negative, and now let's talk about the bull case for Target and if they have an economic moat or not. Number one, I would argue, is the shopping experience. And I say that because the shopping experience tends to be more pleasant because of the type of customers who choose to shop at a Target. It's the millennial mom with like 5 kids. And in reference to those customers, for the most part, they tend to go out of their way to avoid a Walmart. And number two, I would argue, is their in-store brands. Target is pivoting into promoting their own store brands on the shelves rather than name brands, which is copying the Costco Kirkland playbook and also Walmart's great value. And number three is their utilization of social media. I think Target does a really good job of using TikTok influencers to highlight Target's merchandise, their t-shirts, their pants, anything, right? And they have really good partnerships with these influencers. So I think it's a good thing. It's a positive. And regarding an economic moat, which come in many different flavors and styles, such as patents, high switching costs, brand loyalty, or even barriers to entry, when I think about Target, well, in urban cities like New York City and San Francisco, they don't have access to a Walmart. So a Target or a CVS is your best bet if you're looking for a physical big box retailer to pick up some random items. Other than that, I don't think Target has an economic moat. Up until 3 years ago, I would argue their brand loyalty from their shoppers was the economic moat, but that's not the case anymore. You have the right and the left boycotting Target at the same time. It's pretty crazy to see. And now let's talk about their most recent earnings report and anything else that's happening as of late. Well, I don't know how else to say it, but they fell short of Wall Street forecasts for their revenue and EPS, which means they missed the top and bottom line expectations. This is not good. And they also cut their sales outlook for the rest of this year. And not only that, their in-store traffic and transactions decreased. And the Target leadership team thinks this is happening because of the tariffs and declining consumer confidence and their updated DEI stance, which I think is really hilarious because at least they're self-aware to know that is one of the culprits. And what's crazy is the leadership team on the call, they spoke of the DEI boycott a few times, but they never had a concrete response as to what they're going to do about it. So in my opinion, I think the leadership team at Target is pretty questionable. However, they recognize it as well because they're replacing 2 of their top brass to change things up because they realize it's just not working out. And prior to this, Target was struggling with people stealing their stuff. So they were losing profits because of that a few years ago. And now it's that people are choosing to shop at the competition because they're tired of Target flip-flopping the aisle of their political beliefs. All that to say, when you think about Target, I guess you could just call it the perfect storm. When it rains, dude, it really pours. But to be honest with you, it wasn't all negative because despite the pain, dude, their digital sales grew by 4.7%. And their Kate Spade collaboration was more profitable than they anticipated. And their same-day delivery orders increased by 36%. So there are some positives their way, but for the most part, overwhelmingly a negative earnings report and their outlook for the rest of the year, no bueno. And now it's time to examine and analyze their numbers, financials, and fundamentals. The first one that we're going to be taking a look at is their market cap because it's one of 2 ingredients to look at their price to sales ratio to figure out if they're undervalued or not. One of the ways to do it. And right now it's $42 billion. But it used to be $129 billion market cap in 2021. So Target has fallen quite a ways in a span of 4 years. And the second ingredient is their revenue. And as of right now, their revenue is $105 billion, which is pretty fantastic to say the least in comparison to their market cap. But something that I want to call out is year over year, it shrank by negative, 0.6%. So it's not growing. And as a matter of fact, in 2022, their revenue was $106 billion. So you're telling me in the past 3.5 years, their revenue is relatively flat. It's not growing and it's not shrinking. This is a company where ultimately, objectively, it's not quote unquote growing. And now we have the numbers necessary to compute the price to sales ratio. Basically, anything less than 1 tells us that the company is either undervalued or that they have weak growth, poor outlook, or that Wall Street just does not like them. And in the case of Target, their price to sales ratio is a 0.41. Dude, that is absolutely low. However, I think it makes a lot of sense as to why it's less than 1. Their growth has been flat. They have headwind after headwind, and it makes a lot of sense as to why Wall Street just feels bearish towards this company. So right off the bat, I can see that Target, through one metric, is undervalued. Their revenue being almost 2x that of their market cap, that's pretty crazy. The next metric that I like to look at to assess whether or not a company is undervalued is their price to earnings ratio, otherwise known as the PE ratio or the trading multiple. And their forward trading multiple right now is a 12.5. which is shocking to say the least, because when you look at their historical trading multiple for the past 20 years, well, then it's a 14.3. So Target is a company historically where their trading multiple has never really been in the ballpark of like Microsoft or Google of like a 40. It's always been around a teenage number. Okay, like a 13, 15, 16. So at 12.5, it's not too far off from the historical trading multiple. But once again, it is below it. So two metrics tell me that indicate Target is undervalued. Now, the next thing that I like to look at is their EPS, the earnings per share. This is their bottom line. When you take into account their net income and the shares that are outstanding. And I care about it because it shows you whether or not the company is growing their profitability per share. And in the case of Target, as of right now, their EPS is $9.13, which is, okay, here's a positive. Finally, it grew year over year at a rate of 2.04%. So at least their EPS is going in the right direction, despite their revenue being flat. And the next thing that we want to take a look at is their debt situation. Because no matter how sexy or beautiful a company is, please do not be blinded by their debt, loans, and leverage. If they are drowning in debt, if any setback, litigation, or their factory production, if anything goes wrong, that could be it for that company to go belly up. If they are drowning in debt and it's not manageable. If they have a lot of debt, but they have the cash flow to pay it off on time and operate their business as usual, then it's not that big of a red flag for me. So how I like to do it, there's many different ways, right? What I like to do is look at their debt to EBITDA situation, because all else being equal, we can look at their EBITDA to say it would take this many years to pay off their total debt. If all else were to be equal and nothing were to change and their EBITDA were to remain the same for the next 1, 2, 3, whatever it is that we're about to see right now. And to do that, we need to figure out their debt picture. And as of right now, their total debt is $19 billion. In contrast, their revenue is $105 billion. So when you put it into perspective, it's not too bad. And their EBITDA, what do we got right here? Their EBITDA is $8.9 billion, which means their debt to EBITDA ratio is going to be a 2.02. It would take them 2 years of their EBITDA remaining the same to pay off all of the loans on the books, which for me, the golden standard is a 3 or below. If you have a debt to EBITDA ratio of 1 or less, that's phenomenal. For them to be a 2, I think their debt levels are manageable, and I would say this is pretty good. So their EPS, their debt situation, not bad. And based on two metrics, they're undervalued so far. And the next thing that I want to look at is their operating margin. What are their profits from their operations? Now, they're a big box retailer. So I'm going to tell you right off the bat from somebody who has done a case study and has analyzed Walmart and other retailers that it's going to be a very low single-digit number. And in the case of Target, it's going to be a 5.59%. 5%. So even though their profit margin might not be that high, such as that of a software service company, like theirs is usually like a 40% operating margin, but that's because their overhead costs and their inventory is almost non-existent, right? For a big box retailer, the reason why they're able to be so profitable despite having an operating margin that is a low single-digit number like Target of 5% is because of the amount of volume of sales that they generate. Because they sell so much crap in 365 days, it doesn't matter. They still have free cash flow going into their pockets despite having a smaller margin number. So it really depends on the industry. And year over year, that's a growth of 3.9%. And by the way, the numbers that you see on your screen right now is based on United Healthcare, which is a company that I just analyzed, did a deep dive on, and I gave a price target for. If you haven't watched that video, go and watch it. I promise my deep dives are really thorough and you'll learn a thing or two. Now, the next thing that I like to look at is the return on invested capital. We're not going to do the return on equity. And basically it tells us how good is their CapEx spending. How much profit do they make for every dollar of capital that's invested into the business? For instance, if Target says, hey, we're going to throw down $5 million in order to open up another fulfillment center, the ROIC tells us, will opening up that factory give a good ROI? The basic minimum number that you want to see in any company is at least 5% ROIC. If it's like 1 or 2 or 3%, dude, run the other way. Close the door, start praying, and say goodbye to that devil. You don't want to be anywhere near that company. But if it's at least 10%, then we're talking. I would say that's the golden standard, 10% and up. And if it's above 15%, then it's a beautiful company that knows how to use their capital to deploy more factories, production lines, to do whatever it takes to increase their output. And for Target, their ROIC is a 10.85%, which meets the golden standard. However, the tiniest little red flag needs to be raised to the sky right now because that's a decrease of negative 6.6% year over year. What you want to see when it comes to the ROIC is a trend that is relatively stabilized, flat. If they can remain at 10.8% year after year, that's pretty good. Unlike other metrics, such as like the free cash flow or the revenue or the net income, where you want to see the trend up and to the right, with ROIC, a stabilized number is not bad at all. Like, that's what you want to see in a metric. But I think it makes a lot of sense because they're going through the growing pains of expanding their e-commerce footprint to catch up to Amazon and Walmart. Believe it or not, even up to like 6 years ago, dude, Walmart's e-commerce capability and capacity was trash. I would even argue Target was the better e-commerce retailer 6 years ago. However, not only did Walmart catch up to Amazon and Target, but I honestly think that Walmart and Amazon are pretty neck to neck in that e-commerce race, and Target is just falling behind. It's like an obese guy waking up one day and deciding to run a marathon without any training at all. They're struggling by mile 2, and they're thinking about tapping out by mile 3. That's Target. And the next metric that's really important is their shares outstanding situation. What we want to know as investors is this company diluting the shareholders by issuing more shares, or are they buying back the shares? Because believe it or not, if there's less shares outstanding, that means for every share that you own of that company, it has more quality. Because less shares of a company outstanding means more dividends per share, more free cash flow per share, and their EPS improving as well. So in a potential investment, we need to see them be buying back the shares. And in the case of Target, this is a yes. Since 2010, they've been aggressively buying back the shares. As of right now, it's currently 457 million shares outstanding. Back in 2010, it was like 750 million shares. So you do the math. They're buying back those shares, and I think it's a really good thing to see. I would even argue by 2030, it's probably going to be down to like 400 million shares, which is good. The next thing is going to be a technical analysis indicator, which is the 200-day moving average. It basically tells us, is this stock price right now overvalued or undervalued according to their past 200 days? And for Target, their 200-day moving average is $130. Clean, flat, 130. Which means since their current trading price is like what, 94, 95 bucks, depending on when you watch this, could be as low as like 91 or even 97. That means they're way below their 200-day moving average. As a matter of fact, it's below the 200-day moving average by 27.5%. And I don't know if you care about this or not, but according to my analysis, it does seem like Target has a line of support at around the $86 per share price point. If for whatever reason the market goes on a sell-off or more tariffs are announced and Target falls below that magical number of 86, this is not financial advice, but it could be a free fall down to 80 bucks a share or even 75 bucks. However, for the most part, during the normal trading stock week, if their price hits like 87 bucks or even 86.50, they should rebound and rally back up to like 88 or even 89. This is a technical analysis indicator. It's all fluff, okay? It's not a science. It's just based on the stock chart and their trading pattern. So don't read too much into it. All you got to know is they're undervalued according to their 200-day moving average. And the next thing that we want to take a look at is their performance in the stock market. How I like to do it is the compound annual growth rate. When you break it down to an annualized level, meaning year over year, 365 days on average, then it allows you to compare it to another potential investment or even benchmark it to their peer or competitor to figure out, is this company good or not? And the CAGR, which is the compound annual growth rate, takes into account the share price appreciation or depreciation plus the dividends paid out. So it's a holistic picture. And in the past 20 years, on average, every single year, Target grew at a rate of 5.37%. That's not good, friends and family, because in comparison, the S&P 500, which is the standard, the market that everyone wants to beat, well, in the exact same time period, 10.2%. I promise I'm not a racist, but in the past 20 years, you would have been better off investing into the S&P 500 like VU or SPY rather than Target. Because I'm going to be completely honest with you, 5% year over year, that's just not good enough. Well, anyways, we're going to be moving on to their dividend profile because I love dividends, okay? Now, for every share of Target that you own, you get paid $4.48 a year in dividends. And then their dividend yield is 4.75%, just shy of 5%, which means the payout ratio is going to be 49.22%. And you get that number by dividing the annual dividend payout of this right here, $4.48, by the EPS. And that's why the EPS is so freaking important. If this number is declining year over year, then do you think mathematically, you don't even need to know that much about the stock market, but do you think the dividend is going to be sustainable? They're going to be able to grow it? No, that's why the EPS is important. So the payout ratio tells us 49%, which means they're using roughly 50% of their net income, which means all of their profits, in order to finance the dividends through the accounting method. And I say this because later on, we're going to be looking at what actually finances the dividends. And year over year, they're growing this number, $4.48, at a rate of, wow, this is really impressive, guys, 1.82%. It's like someone putting in their dating profile that they're 6'1", but they show up to your blind date and they're barely 5'5". It's like, dude, what? You said you're 6'1". And the next thing that we like to look at is the free cash flow per share, because the real ones know that cash flow is what finances the dividend payouts. On the books and through an accounting perspective, yes, it's the EPS. However, it's the cash flow that pays for the dividends. Because if a company does not have the cash flow, then that means they're going to have to take on loans and more debt in order to pay out that dividend. And I'm telling you, there's a lot of companies that actually do that because they want to keep their status as a dividend aristocrat or dividend king, or if they have a record of paying out their dividend and increasing it for the past like 20, 30, 40 years, do you really think they want to break that record? No. So they're going to do whatever it takes to pay for that dividend. It's sad to see. So that's why the free cash flow per share really tells us, is the dividend going to be sustainable or not? And in the case of Target, it is $7.68. So you do the math, right? If the dividend payout is $4.48 and they're making $7.68 of free cash flow, that means cash left over after paying for all of the operations, overhead costs, all of the part-time employees, all of the people that are pushing the carts in the parking lot. You pay for all of that. What's left over is $7.68 per share. Tells me that the dividend is sustainable. And the free cash flow per share, you want to see it be growing. Okay? And in the case of Target, that is just not the case, guys, because it decreased by 6.8% year over year. That's not good. And their free cash flow dividend payout ratio is 58%. So they're utilizing 58% of their free cash flow in order to pay out this dividend right here. But remember, they've been growing it for the past 55 years. So we got to give them credit where credit is due. It's just like Zynga back in the day. If you remember what that is, props and kudos. They're doing a great job of sustaining that dividend, because if you think about it, the dividend is the consequence, the result, the final output of a company doing all of the little things correctly and crushing their operations, because you can't pay a dividend unless you have excess cash on hand from kicking butt in your operations or in your business. So if the fact that they've been doing it through all of the recessions, through all of the bear markets and bull markets, honestly, when you think about it that way, their dividend profile is pretty spectacular. And I want to remind you once again that 4.7% dividend yield qualify dividend payouts, which means it's going to be taxed at the capital gains tax rate, which means for some of us watching this video, you're going to be taxed at a rate of 0% for those dividends. Okay? Pretty good stuff. So with the numbers out of the way, these are all the competitors and peers to Target, in my opinion. I think pound for pound, their biggest rival is, without a doubt, Walmart. However, I also think Costco belongs in that conversation. Even though Costco requires a subscription, a membership fee in order to go in through the doors, and in some places, dude, they don't even allow you to go to the food court anymore. When I used to live in California, I didn't have a Costco membership, but I would buy a slice of pizza or get their hot dog drink combo for $1.50 by going to their outdoor food courts. Amazing. But apparently that policy has changed. And then, of course, there's Amazon, Dollar Tree, and Dollar General. So after looking at their numbers and thinking about their situation, how much is Target actually worth as a business in the stock market? But before we get to that point, let's talk about their 365-day trading range. Now, what is the highest price that they were ever at, and what is the lowest price that they were at in the past one fiscal year? Well, the highest point was $167 a share. For them to be around 95 right now, they have fallen quite a lot, because their 365-day low is $87 a share. I want you to think about that range, okay? 167 to 87. Because now I'm going to tell you their intrinsic valuation. Based on their free cash flow growing at a rate of 3% year over year, which, mind you, when I looked at and analyzed their free cash flow, dude, it's all over the place. Sometimes it's like growing at a double-digit rate, and sometimes it's even negative. It's really unpredictable and not stable whatsoever. However, with a projection of a 3% growth rate year over year, then I think Target is valued at $142 a share, which is still within that range, right? 167 to 87, 142. If we only assess Target based on their dividend profile and a growth rate of 3%, even though historically for the past 5 years, their dividend growth rate is 14%, and that's because in 1 year, I think it was like 2021, they grew their dividend at a rate of like 50, 60%. They just went too bonkers, too ham, instead of playing it safe and steady and growing it at a rate of like 5 or 6%. They decided to go too crazy, and that's why it inflated the numbers, and the number is now at a 14% dividend growth rate, even though for the past year, it only grew at a rate of 1.8%. But if we say 3%, then the dividend discount model says Target should be valued at $112 a share, which is slightly above the price that they're trading for right now. And I hear you, 142 for the free cash flow and 112 for the dividend discount model. That's a huge difference. And that's why we averaged the two. Taking that into account, then their intrinsic valuation should be $127 a share. $127. That's their true intrinsic worth, how much Target should be on paper. Now, comparing our number of 127 to that of the Wall Street analysts and taking into account what they think, well, Wall Street believes Target should be valued at 121 per share, which is an upside of 29% from their current trading price. And there's even one bozo out here that's like, dude, Target should be 82 bucks. I'm sure that guy is balding, fat, and has a stinky breath, because that would be a downside of 13% from his current trading price. Even I don't think that Target should be 82 bucks. But there's someone out there that's like, it's 82 bucks. I'm telling you right now, he probably has pepperoni nipples and he's not fun to talk to at a party. 82 bucks. That sounds ridiculous. 121 sounds more realistic and in line with what we think. So if we were to average those two, of our 127 and 122, then let's just go ahead and say 125 is the intrinsic valuation for Target. So what is a good value investing price to buy into Target then? Because as a value investor, you don't just buy into a stock at any willy-nilly price. Especially if they're at their 52-week high, no, you don't want to do that. As a value investor, you only buy into a stock or dollar cost average into it when you have a margin of safety baked in, when they're below like 10%, 20%, or 30% from their intrinsic valuation, their inherent worth. Does that make sense? So with that in mind, a good price to buy Target is $100 per share. $100, you get a huge margin of safety baked in. An even better price, I'll give you that. A bargain price to buy Target is $93.75 a share, which is their current trading price. So to buy into Target right now, I think it's a bargain price. And that's not financial advice, it's just what I think. I'm an idiot. And then of course, a steal of a price to buy into Target is 87 bucks a share, or anything less than that. Will it ever reach that point again? To be honest with you, it could. 2025 has just been a ridiculous year in the stock market. Even some of the heavy hitters and blue chip companies, dude, they went down by like negative 30% and now they're back up. And in any given year, it's almost impossible to predict what the stock market is going to do. But in 2025, it's just been crazy. There's a lot of ups and downs. I guess the word for it is volatile. Which brings us to the final verdict. Is Target a dividend compounder that's delicious? Are they a disgusting Debbie? What is this company? So, I'll preface it by saying this. I really wanted to like this company because when I was on vacation in the States for about 2 weeks, my wife and I exclusively shopped at Target to pick up whatever we needed that was random. And I'm going to tell you, on an anecdotal level, it was a great experience. Regardless of what city and location, that Target was always well-staffed, well-lit, it was clean, everything that we needed was there, and the prices were pretty good. However, after looking at their numbers and their current situation, it's really hard for me to like them as an investment. And their balance sheet is just average. It's not a fortress. It's not beautiful. It's just average. So unfortunately, I think Target is one of those businesses where it's good. However, as an investment in the stock market, I don't know about that, Chief. However, as a dividend income type of stock, I think it's not a bad idea at all. A 4.7% dividend yield, and they're growing it for the past 55 years. That's really impressive. By the way, I'm looking out my window right now because they're cutting grass and using the leaf blower. So if you hear that, it's not me letting out gas. I'm not farting. It's just they're cutting grass. Okay? But on the other side of the argument, if you're looking for a CAGR of at least 10% a year in the long run, a compounder, then I don't think this is the stock that I would go with. So does it come as a surprise that if I were to rate and grade Target, I think it's a C? I was going back and forth on whether or not I wanted to give them a C+, but I think this is a very average business, and especially stock in the stock market. And so overall, I think the label that we're going to give them is this one in the middle. I think they're just decent. Because when we think about it, what exactly is a dividend compounder? What this channel is named after. It's a dividend paying business that has predictable cash flow despite market conditions. And in due time, they're going to take your initial investment into them and compound it by 2x, 5x, or even 10x. So if I were to invest $100 into a dividend compounder, then in the span of like 5 years, sure enough, it should have compounded into like $200 or even $250. Does that make sense? So when I think about Target, their cash flow is not steady. Their revenue is flat. Their margins are decreasing and they're losing market share to the competition. And ultimately, their performance in the stock market really underwhelming. A CAGR of 5%, I don't know about that. I think if you're bullish on the big retailers in 2025 and beyond, I think you might be better off with going with Walmart, Costco, or even Amazon. I think they would be the better choice because their business model and the way that they operate, they're not afraid to innovate and they take into account the consumer's preferences instead of playing catch up. Because when I think about Target, I feel like they're trying to emulate and copy JCPenney's and Macy's, right? They're trying to sell more clothes, jewelry, and home goods rather than groceries and consumer staples like Costco and Walmart. So I don't know if I believe in the growth story for Target. Now, with that said, do I think they're going to disappear? Do I think they're going to go bankrupt? Absolutely not. So that's my thoughts and opinions on Target. A C, and they're decent. And before I talk about my game plan in regards to Target, I mean, just look at this, right? This is the adjusted stock price total return. In 20 years, your investment into Target would have grown by 185% in 20 years. Guys, that's just not good enough. Case in point, if I show you their competitor Walmart in the exact same time period of 20 years, your adjusted stock price total return would have been 810%. So it just shows you that Target pales in comparison. So what's my game plan with Target after doing my homework and research? Well, when I think about the facts, right, Target has not grown since the end of 2021. They've just been slowly shrinking. And against the retail competition, Target sells more discretionary items like household goods and clothing. So during tough times like right now, consumers are going to be pulling back spending that affects Target's top and bottom line. And that's why I keep saying that Target needs to implement consumer staples into their stores. So as an outsider looking in, what needs to happen with Target? A turnaround story. They need to invest in building out their e-commerce capabilities, especially the digital platform. As of right now, merchants and vendors, it's invite only. Instead of doing that, I think they do need to copy the Amazon and Walmart playbook and allow almost anyone who wants to operate on Target's digital platform to do so. And I think there's plenty of room for them to partner with beauty supply, makeup, skincare type of companies. I feel like that's up into the alley of what Target is known for. Also, like I just said, they need to expand their grocery offerings. Because when I think about it, when Laura, the 45-year-old single mother of 7 children, hops into a Target to do some retail therapy and try on some dresses, wouldn't it be nice to have a one-stop shop where she can also pick up the groceries for the kids as she buys the size XXL panties? Right? And I feel like Target right now, their grocery is more so just a limited offering. I think you're better off going into a Walmart, believe it or not. But anyways, if they build out their e-commerce infrastructure and expand their grocery footprint, that's going to be lots and lots of CapEx, which, as you know, in the examples of Microsoft and Google, Wall Street absolutely hates CapEx. But I think that's really short-sighted perspective because you need CapEx. You need to build into the business in order to make more money. You can't just magically grow. You need to build out more production hubs, more stores, more grocery distribution centers. That's the only way that you can essentially grow. So Wall Street, I don't know, that pisses me off. But I think CapEx is the only path forward. When I think about Target, I just don't see how they're going to come back from them shrinking year after year. Now, if they were to integrate and implement trendy brands into their stores with more collaborations and just physically getting people into the stores, I think that would also help their business out a lot. And that's why earlier I was suggesting it would be not a bad idea for them to have like a board game or a bookstore concept within their stores. The reason why I'm suggesting that Target goes gung-ho into CapEx is because whenever Target has extra cash on hand, based on their history and what they choose to do, they always default to doing share buybacks and growing the dividend at a very aggressive rate instead of investing back into the business. It's almost infuriating because when I look at Target, and even you, right, there's plenty of room for improvement. They're not perfect. They're not polished. So for them to throw down all their excess capital to buy back more shares just pisses me off because they should aggressively innovate and push the boundaries instead of behaving like Western Union. Another company, a digital payment processing business with plenty of potential in the finance space. But what did he do with excess cash on hand? They just do share buybacks. Dude, it's so annoying to see. Don't get me wrong. I love that Target is committed to growing the dividend as a dividend growth investor. I like that. But what I'm saying to you is if the business is stalling and they have a lot of headwinds in their way and your competition is just kicking your nuts, I think using that capital to heal the wounds and to come back with reinforcements would be a better business call. But what do I know? So ultimately, my game plan, based off of numbers and financials, things don't look too good, especially the trend that it's going in. Declining and decreasing is the opposite of what you want to see as an investor in a potential investment. So because the numbers are not there, when it comes to Target, I think more so, if you're going to invest into them, this is not financial advice. It's going to be more so of a narrative thing, right? What is their future story, their growth story going forward? Do I believe that Target is going to bounce back from this? Will their future be bright? Or will they crash and burn like Sears and Kmart? I think those are the questions that just keep going back and forth in my tiny little pea brain. But one of the questions I'll answer out loud, do I believe in Target? Well, I don't think they have any initiatives or changes upcoming in the pipeline that makes me excited, right? And so I think for my personal portfolio, does it come as a surprise that I'm going to say this? I don't think I'm going to entertain the idea of buying into Target unless it hits a very stupidly low valuation. We're talking about like $85, then I'm in. But at its current trading price of like 95, I just think there's better options out there. But with that said, for the individual is a senior citizen and is retired, I think Target is a fantastic qualified dividend payer because it makes a lot of sense. I'm not expecting for the share price to appreciate by much, but for their dividend, it looked to be sustainable and it looked very healthy from what I saw. And it'll help bump up the portfolio's overall dividend yield. So it does have a place in certain portfolios, but for someone that's in his mid-30s who prefers taking showers naked and dividend compounders, I just don't know about Target. I don't know, maybe I'll buy into them if they hit $85 a share. But let me know what you guys think. Do you disagree or disagree with me? Like, what is their catalyst? What is their future story or whatever it is that they're doing that makes you really excited that I am just not aware of? Let me know. Are you buying into Target? Anyways, none of this video was financial advice. I love you guys. Stay safe and good luck in the stock market. And I'll talk to you guys really soon. Peace.